back to yet another AP instructional video. My name's Matt Romano. I'm coming to you from Atlanta today. And today we've got a lot today. We've got the last three topics of Unit 4, which means two markets, two graphs, and monetary policy, all of monetary policy. So being a review video, obviously you've done these topics before, you know what to expect, but you also know this is a lot of stuff. So we're going to work our way through it. I don't want to take too much of your time, but as much detail as we can get in a short review video, trusting that obviously you've already done this stuff, your teachers have already done a great job of teaching you, and this is a refresher of those big topics. That said, again, it's a lot of stuff. So we're going to start with the money market, talk about the money market. Obviously, like every graph that we do, every time you introduce a new graph, you have to talk demand, talk supply, talk about shifters, talk about equilibrium, disequilibrium, all of those different concepts. Then we're going to jump into monetary policy, which in and of itself is a big topic. But again, it's a review. So we'll talk about our policy tools, connect it to the different graphs that obviously we can use to illustrate monetary policy, and even connect it to some of the data that we do, the data analysis of monetary policy when it comes to changes in money supply and money creation process. And then finally, we're going to finish up with the loanable funds market today. There's a lot here. There's a lot of objectives related to the loanable funds market, but we're going to keep it as concise as possible, stick to the big things. And again, a refresher on what the loanable funds market is and how we can apply it in many different ways in this course. So what does that mean? Let's go ahead and get started on that. And we're going to start with the money market. As I said, we're going to start with the money market, go one piece of the money market at a time. So you'll recall that when we draw the money market graph, we are showing a relationship between nominal interest rates and the quantity of money. So quick reminder, and you did this with the Fisher effect, the Fisher equation, nominal interest rates, those represent the interest rates that you're charged. Those are the interest rates in current dollar values, for lack of a better term. If you were to borrow money, the rate that you have to pay on that borrowed money, that's the nominal interest rate. If you're lending money, you should be paid the nominal interest rate. And we're looking at the relationship, again, between the quantity of money and that nominal interest rate. Demand for money is going to exhibit a negative relationship or an inverse relationship, like most every demand curve is going to show. At those higher nominal interest rates, people are going to hold on to less cash. Frankly, with a higher nominal interest rate, you can get more money as a lender. So why hold on to your money as cash? Cash is the opportunity cost. I'm sorry, interest rates are the opportunity cost of holding cash. As those interest rates go down, the opportunity cost of holding cash goes down. You're going to hold on to more cash at lower interest rates. There's less of an incentive to put your money away. So again, there's the inverse relationship. Money supply, on the other hand, we're going to draw as a vertical line. We're going to say that the money supply is independent of the interest rate. And the reason being, the money supply is determined by the monetary base, which is determined by the central bank. So we're going to make a direct connection there to monetary policy, to central bank policy, and changes in the money supply curve. And we're saying there that monetary base, that money supply that we're showing here, is independent of any changes that occur with nominal interest rates. Now, you should expect this, as is always the case, where those two curves intersect. That's going to tell us our equilibrium nominal interest rate and our equilibrium quantity of money, both supplied and demanded. That said, like any other market, we're not necessarily always at equilibrium. So we want to be aware of those scenarios when we're not at equilibrium and what happens as a result to correct the market to get us back to equilibrium. In a case such as we have right here, where the market is calling for interest rates that are higher than equilibrium, as we have with I1 over I, the result is going to be this gap that I've shown in green, which is going to indicate a surplus of money, where the quantity of money supplied, that individual point, that specific point on the x-axis that corresponds with the money supply curve, is greater than the quantity of money demanded, that point on the money demand curve at interest rate I1. And as you well know, if you recall, our lessons of supply and demand tell us if this is the case, when a surplus occurs, the market's going to adjust and we're going to see interest rates fall. And those interest rates are going to fall back down to your equilibrium interest rate I. What that really should highlight or illustrate for you, This is merely another example, another illustration of how we use supply and demand, another market where we're using those basic rules of supply and demand. Don't lose sight of that just because the money supply curve looks a little bit different. It's perfectly inelastic, it's straight up and down, it's vertical. It looks different than your standard supply curve. The basic rules still apply. Nominal interest rate is just a price. It's no different really than, it just happens to be the price of money. So with that in mind, if the interest rate that's currently being charged to borrowers, or the interest rate that's going towards lenders, if that happens to be lower than the going equilibrium interest rate, your quantity of money demanded is going to exceed the quantity of money supplied, and the result's going to be a shortage. And what we would expect is, left alone over time, interest rates are going to adjust, and they're going to adjust back to equilibrium. So again, be aware of surpluses and shortages. It can happen. We can have disequilibrium here, but also be aware that just like any other supply and demand model you studied, the market's going to correct itself, and it's going to take those interest rates right back to equilibrium in the long run. All right, now shifting those two curves, the money demand curve and the money supply curve. Start with money demand. A rightward shift of money demand obviously would result in a higher interest rate. We would go from I to I1. What would cause that? Why would individuals demand more money? Well, the first and maybe most obvious that we usually talk about is price level. And then alongside that, we often talk about real output, changes in real output. So in this case, we've shown an increase in the demand for money. This is likely to result because of an increase in price level. Now, why would that be? Again, think about the term money demand, demand for money. It might be easiest, and there could be exceptions, but it might be easiest to, at least in the beginning, visualize this as demand for liquid money. Think of it as the cash you need in your pocket on a day-to-day basis, the cash you need in your wallet on a day-to-day basis to buy food, to pay the bills, to do the things that you've just got to do. What would cause your demand for money to increase? I'm not talking about how much money you want. That's a whole different situation. We're talking about your demand for money. The primary shifter of that is going to be a change in price level. And if price level tends to rise, if we have inflation, over time, we realize that's happened. We realize that it's affecting our bottom line at home, that we can't buy as many, say, groceries as we used to, and we're going to start to demand more money. So there's a direct connection there between changes in price level, changes in money demand. The same could be said of changes in real output. If real output goes up, we also see an increase in money demand. Now, turn those around, go the other direction, and in theory, you could also say there's a decrease in money demand. That can happen. It's hard to fathom. I know it's hard to visualize, oh, I demand less money, but it can happen. So in theory, that's a possibility. That is something you could see in AP macro, a decrease in money demand because of a decrease in price level or a decrease in output. How about money supply? Well, money supply is a little simpler. Really, because we're basing money supply on the monetary base, and we're basing it on being fixed by the central bank, we're going to connect changes in money supply to changes in monetary policy. So what we've shown here from MS to MS1 is an increase in money supply, and that increase in money supply is a direct result of money creation that comes from expansionary monetary policy, which we're going to talk about very shortly here. So here we see a rightward shift in money supply, resulting in a lower interest rate. We're going to indicate that's a result of monetary policy. A contractionary monetary policy is going to have the opposite effect. It's going to shift money supply back to the left. That takes us into monetary policy. So before we can get into it in much depth or detail, I want to make sure we can talk the talk. You've got to know certain terminology with regards to monetary policy. And again, this extends well beyond AP macro. Yes, you have to know this for AP macro. To do well in the exam, to do well in the course, you have to know this terminology. But much more importantly, to keep up with world events, to listen to Janet Yellen on our interview the other day at AP Masterclass, you've got to know what these terms mean so that you can be an informed citizen who keeps up with monetary policy and what's happening out of the central bank. So 4 terms that apply to most any central banks, just general terms regarding monetary policy. First being, of course, monetary policy. What is that? Monetary policy is essentially stabilization policy stemming from that central bank or that monetary authority of any economy, of any nation. And they have the ability there to manipulate interest rates and to manipulate money supply in whatever form it takes in that particular society. So these others are going to be related to that. Overnight interbank lending rate. You'll see that term in some of the AP macro curriculum. Really all that says to us is that banks do lend each other money. They lend each other overnight. They do it for a variety of reasons, a whole host of reasons. Before taking AP macro, that may not have been something you knew. It's something you want to be aware of. And when you go from economy to economy, you learn the names and forms of those different rates. And we're going to talk about one of those for the US. The lender of last resort. The central bank can serve as the lender of last resort. And I referred to it once, I probably will again, but in our conversation in the AP Masterclass the other night, Dr. Yellen referenced this. She talked about the role of the Fed in the United States of being a lender of last resort, which essentially means for banking institutions, if there's nowhere else to turn, if there's no one else to provide liquidity, they can come to the central bank. And that's a function that all central banks are going to serve. It's not that banks want to necessarily borrow from the central bank, but they can. They can when things become dire, as they have recently. They have that option. This is where learning a little bit of the history of the central bank can actually be really interesting and really informing, because you could find different times in history, different points in history where this role became more elevated, maybe became more important because there were no other options for banks and it allowed for liquidity to continue. Finally, a fourth one, open market operations. You're going to hear a lot about open market operations. These take on a lot of different forms. We talk about them in really one context in AP Macro, but they take many, many different forms. Open market operations refers to the central bank doing what just it says, entering the open market. Think supply and demand. They enter the market with commercial banks as a way of either providing liquidity or restricting money creation to slow things down. And they're purchasing financial assets from banks. And again, this is something that once you know what open market operations are, you're going to hear them referenced by the Fed and financial news all the time. In our context, we typically talk about open market operations with regards to purchasing treasury securities or purchasing bonds, which bonds are a type of security. We use those terms synonymously. But as you expand your understanding of monetary policy, you'll see that there are other assets as well that can be purchased through open market operations. Specific to the US, let's go ahead and use some of this terminology as well. The Federal Reserve, first of all, the Federal Reserve System, that is the central bank of the United States. And if we were in a day one of talking about monetary policy, I'd really go into depth about what that means. I'm not going to go into too much depth today, but I would encourage you to learn a little history of the Fed. It's really a fascinating history. It's not part of AP Macro. No, you don't have to know the history and structure in order to do well on the exam. But when you find out that, first of all, this is the third try for the US in terms of having a central bank, when you find that the idea, the concept came from, really stemmed from a series of panics and bank runs, the last more or less being the 1907 financial panic, which really mirrored in a lot of ways 2008, 2009. It's a really interesting story, and it really helps illuminate what the Fed is and what the central bank does in this country. The system, the reason it's called a system is because it is divided into 12 districts, different regional banks throughout the country, which in themselves have branch banks. So it is a system. It's like a web throughout the country, performing the duties of the Fed, but also staying in touch with businesses and banks throughout the country so that there is a system set up for information gathering, for research, and essentially for liquidation, for allowing for liquidity, which is a large role of the Fed. The dual mandate is a term you will hear a lot with regards to the Fed. And again, hopefully you know this already. It essentially says that the Fed has two jobs. Many central banks in this world have one job, and that's to maintain price stability. They have an inflation target. For most, it's about 2%. In the US, in the Fed, there are two jobs. It's to maintain, I should say, price stability, but also to foster maximum employment, to get us to full employment and try to keep us there. And that can lead to a balancing act. Having that dual mandate can lead to a balancing act between expansionary and contractionary policies and what may be most appropriate at a specific time. So when watching the Fed, as I'm sure many of you do now that you know something about it, you start to recognize that they have to really consider a whole host of different indicators and think, what's the best move now? The federal funds rate does come up in AP Macro some. That's the overnight interbank lending rate. That is the interest rate that one bank would charge another bank if they were to lend them money overnight. And then finally, the discount window and the discount rate, that is where the Fed and how the Fed operates as the lender of last resort. If a bank were to borrow money from the Fed, they borrow at the discount window and they are charged the discount rate. So again, got to know your terminology before you can really dive into the details of monetary policy. Otherwise, you're not going to be able to keep up with what's going on. I wanted to add one more piece of information. And again, this is a little more than you need for AP Macro, but it gives you some context and it helps you understand why all of this is going on, why we bother studying this stuff. 5 key functions from the Fed, and this terminology is directly from the Federal Reserve website, federalreserve.gov, which I encourage you to go to because you can learn a lot there. In AP Macro, we primarily focus on number 1, conducting the nation's monetary policy. And that's entirely true, and it is probably their first and most important role, but it's not the only thing they do. So putting it into context does help, helping maintain stability of the financial system, which can come from the form of providing liquidity through the discount window, could come from regulations, which is number 3, supervising and regulating financial institutions, fostering payment and settlement system safety and efficiency. That's making sure checks are processed, making sure that payment goes through, and then finally promoting consumer protection and community development. The Fed does a lot from an education side. And again, I encourage you, go to that website and see what they have. They're out there teaching, they're doing workshops, they're working with teachers like me so that we better understand monetary policy and how it works. And we can pass that along to you students. So there's a lot that goes on in the Fed. In the context of this lesson, in the context of AP Macro, we are focusing on monetary policy, but do know there's more to it than that. Okay, so let's go to monetary policy. You've seen this before. I believe I've used this on a previous lesson. In AP Macro, we focus on 3 general tools of monetary policy. You should know there are many, many other tools that the Fed can use, but this is Econ 101. This is basic macro, and we're going to start with the basic, what I would call traditional tools, get an understanding of those, and then you can expand your understanding in terms of how these tools have been utilized in different ways and how additional tools have been added since the financial crisis, 07, 08, 09. And there's a whole lot of new stuff out there that the Fed can do. And if you've been paying attention recently, you've seen some of that. You've seen mention of some of that. What you have to know for AP Macro are these three primary tools, which can, again, take some different forms, especially open market operations. So what is open market operations for review's sake? That, again, is when the Fed or any central bank, for that matter, enters the open market and they are buying or selling securities with those commercial banks. And the purpose of that is to impact bank reserves, which is going to impact how much money banks have to lend. So when it comes to expansionary policy, think in terms of a T account, like you did yesterday in yesterday's lesson, the first half of Unit 4. If the Fed, in this case in the US, the Fed is buying securities from commercial banks, what's happening? They're purchasing a financial asset. Money is going directly from the Fed to that bank. In fact, the Fed is just entering it into their accounts. The Fed then owns securities. So the amount of securities owned by the bank has gone down in exchange for bank reserves. And as bank reserves go up, now the bank has more money to lend, which should cause interest rates to fall, initiating lending activity and economic activity. And that's what the Fed's trying to do here. They purchase securities, they buy bonds in order to increase bank reserves, lower interest rates, and try to encourage more lending activity, encourage more spending. With those lower interest rates, we hope to see, the Fed hopes to see, increases in consumption, increases in investment. On the contractionary side, they do the opposite. They sell securities. So now the Fed enters the open market. They sell the securities to the banks. Money comes out of bank reserves. Bank reserves shrink, which should cause interest rates to go up. And that should slow down economic activity, slow down lending activity. They would do that when they want to slow down inflation. They want to bring down inflation. So really, understanding the dual mandate can help you better understand the policy directions and when they would be implemented. Expansionary policy, when you want to lower unemployment, you want to give a boost to output. Contractionary policy, that's when you tap on the brakes, like you're driving a car, you tap on the brakes to slow down the inflation. Having to balance those two can make this a little more complicated. It's really hard to do expansionary policy if you're worried about inflation. Really hard to do contractionary policy if you're worried about unemployment, because it could have unintended consequences. So we want to be aware of both of those. Now, again, in AP macro, we're going to make it pretty straightforward to you which one is the correct policy at any given time. But in the big picture, we have to consider that this is what's happening. Discount window lending. Remember, that's where banks are borrowing money from the Fed. So is the Fed going to encourage banks to borrow or discourage banks from borrowing? Again, this goes back to bank reserves and what does the Fed want? Do they want banks to have more money on reserve or less money on reserve? Do they want to encourage more borrowing or they want to discourage the borrowing? To encourage more borrowing, they're going to lower the discount rate. And the discount rate is that interest rate that the Fed is going to charge banks when they borrow at the discount window. So at the lower discount rate, there's greater incentive for banks to borrow money. But if they raise the discount rate, that's a signal that they want to tap on the brakes and maybe slow down some of that borrowing. With the reserve requirement, as you know, the reserve requirement is a percentage of demand deposits that banks have to keep on reserve. If they were to lower the reserve requirement, which we're going to look at in just a second in a very realistic context, if they lower the reserve requirement, what that means is banks don't have to keep as much on reserve. They have more money to lend. So that's to encourage lending. It's going to lower interest rates and hopefully encourage economic activity and shift AD to the right. If they were to raise the reserve requirement, they're requiring banks to keep more money in the bank. They don't have as much to lend if that's the case. So that's going to slow things down. Finally, let me circle back to open market operations. One thing I did leave out there, the manipulation of open market operations is going to have an effect on the federal funds rate, which I mentioned a moment ago. Federal funds rate being that interest rate that banks charge each other when they lend. We want to be aware of that and make that connection here. All right, let's look at application of these policies on the money market graph. So bringing those first two topics together. Expansionary policies, whether it's purchasing securities, lowering the discount rate, lowering the reserve requirement, they're intended to encourage economic activity. They do so by expanding the monetary base, which is going to lead to more money creation. With bank reserves being higher, money creation is going to increase. With more money available, money supply shifting right, interest rates are going to fall. And we need to be able to illustrate this. We've got to be able to draw a correctly labeled graph of the money market. And on that correctly labeled graph, show the effects of expansionary monetary policy. And this is how we do it. A rightward shift of money supply leading to a decrease in interest rates. What if interest rates did not decrease? Well, you would have interest rates that are greater than where equilibrium wants to be, resulting in a supply greater than the quantity demanded and resulting in a surplus. On the other hand, if there was a contractionary monetary policy, if the Fed were to sell securities, raise the discount rate, raise reserve requirement, and in doing so, reduce the amount of excess reserves in banks, then you're going to see an increase in the interest rate. So we show a leftward shift in money supply that corresponds with a contractionary policy, and that leftward shift of money supply is going to lead to an increase in interest rates, which will slow down economic activity. All right, let's dive into reality a little bit here. I want to look at some of the verbiage from recent monetary policy actions. And to do so, I do this often with my own classes. Let's look at the press releases that the Fed has been putting out in the past month or so. March 23rd, this is when things really started to happen. And a lot of things happened very quickly. The Fed had to move rapidly. They put out a press release saying this. And what I really want you just to focus on are the highlighted areas in blue. The FOMC, the Federal Open Market Committee, that's who essentially determines monetary policy, dressed the desk, that's the open market desk who does the trading, to undertake open market operations. There's that word that we learned in class. It wasn't just so that you had something to do in class one day or a word to look up. That's a real thing. This was on March 23rd. Directs the desk to undertake open market operations as necessary to maintain the federal funds rate in a target range of 0 to 1/4%. So what they did is they essentially brought the federal funds rate down to about 0. There's a range there, 0 to 1/4%, but it's about 0. There's basically free money between banks. And what that's going to do is that's going to have a domino effect, and it's going to bring down interest rates on any money that we as households or businesses want to borrow as well. We can demonstrate this, the impact of this on a T account. So I just made up a T account. This is just a hypothetical bank here with some made up numbers. And we want to consider, okay, as a result of this, the Fed is now purchasing Treasury securities. So from our hypothetical bank, what would it look like when the Fed purchases $50,000 worth of Treasury securities from a bank? Well, this entire transaction is going to take place on the asset side, first of all. That's an important point. There's no effect on demand deposits. Nothing is being deposited here. When the Fed enters the open market, there's just a transfer of ownership in exchange for money. So the Fed's purchasing $50,000 worth of securities. What is that going to do? Securities are going to drop. They were at $150,000. This bank owned $150,000 worth of securities. The Fed purchases 50,000, and that's going to go down to 100,000. In its place, in that transaction, we're going to see total bank reserves jump up to 550,000. It was 500,000. It's going to go up to 550,000. The next step in this process is determining, calculating how much money could be created from that monetary policy. And if you recall, we had a formula for that. And that money creation formula is to take the excess reserves, or in this case, the change in excess reserves, and multiply it by your money multiplier, which in this case is 10 because it's 1 over the reserve ratio, or the reserve required reserve ratio, or the reserve requirement. So given a 10% reserve requirement, which again, I'm just, for a hypothetical situation, I'm just picking that one out of thin air. Given a 10% reserve requirement, this action is going to create an additional $500,000 to the lending process. You've got $50,000 in additional excess reserves. Multiply that by your multiplier, you get an additional $500,000 throughout the banking system, not in this particular bank, but throughout the banking system. That's, again, connecting monetary policy to the money creation process that you discussed yesterday in yesterday's video. All right, back to the federal funds rate. This is, again, some reality, and I want you to see where we are today relative to recent history for a little perspective on the federal funds rate and overall interest rates in the big picture of things. If you just look at the right-hand side here and you see just how low things have been, we had a span from really late 2007, really 2008 until late 2015, early 2016, where the Fed funds rate was essentially zero. And we're back there again now. You had a short period of time where interest rates were going up, trying really just to get back to normal. Looking at this table from Fred, we can really see just how unusual that period in our history is. But you should also be able to understand what the Fed was trying to do. But to understand even better, let's back up. Take a look at the 70s and 80s. And I want you to recall, I'm sure your class has talked about it, what were the major economic issues in the 1970s and 80s? Well, the 1970s are really defined by that stagflation, the stagflationary cycle that we were going through, where there were high rates of unemployment and high rates of inflation. And what happened was in the early 1980s, you had a Fed chair named Paul Volcker, who determined that really the best way to end this whole stagflationary cycle was to bring down inflation first. You had to do something about the psyche of the American household and American business, where high inflation had become expected, and there really wasn't any expectation that the Fed could fix it. So what they decided to do was, let's drive interest rates up really, really, really high, and really just slam the brakes on the economy, slam the brakes on lending activity, hoping that that's going to convince the American people that inflation can come down. And you know what? It appears it worked. We have really not had an inflationary problem since then. I mean, there have been small periods where maybe it got a little bit higher, but not really. The other thing I want you to see, the other trends I want you to see, the gray bars, as you know from these notations, those indicate recessions. What happens to interest rates? What is monetary policy trying to do every time there's a recession? 1991, decrease interest rates. 2001, decrease interest rates. 2008, 2009, decrease interest rates. Right now, decrease interest rates. Those are all examples in green, those green arrows, that's expansionary monetary policy. They're using open market operations to drive up the monetary base, to increase bank reserves, and to bring down the Fed funds rate, bring down all other interest rates, so that banks will lend more money, so that we as households and businesses will borrow more money. They're trying to stimulate some sort of economic activity when the economy is saying otherwise. That's what's happening here. Again, I think it's a good idea to every now and then just bring yourself back to reality, step away from the textbook, look at reality and say, how is this really applied? And it is. And that's one of the beauties of this course, that it's so applicable in the real world. And here's an example of how that is. All right, discount window. We talked about the discount window. Disclaimer, this is a horrible PowerPoint slide, and I know it, way too many words. I would never expect you to read all this, and I'm certainly not going to read it to you. So I highlighted what I want you to see. It's the discount window. And this is from March 15th. I recall this coming out because it's not often you see this direct references to the discount window coming out of the Fed in a press release, but they do it sometimes. So the Fed started in mid-March encouraging banks to borrow more to access liquidity through the discount window. And you can see that up here. And that sentence right there in blue is really what I wanted to highlight. The Federal Reserve encourages depository institutions to turn to the discount window to help meet demands for credit from households and businesses at this time. They're saying, come to the Fed and borrow money. They lower the discount rate, and they want banks to borrow to maintain liquidity in the system, to keep things moving, to keep businesses operating, to keep households able to borrow and do the things that we need to do, despite the fact that at that point, March 15th, everyone knew a shutdown was coming. So again, example of discount window as it is communicated by the Fed. In that same press release, there was a reference to the reserve requirement. Now, this one really got me because it is so rare that we see references to the reserve requirement. But what I wanted to point out, again in bold here, the board has reduced reserve requirement ratios to 0% effective March 26th. This just happened in the past, month and a half. And it's good to be aware of it, but even better, it's good to see what that looks like in reality. This is actual application of the policies you're learning in AP Macro. If we were to look at this and think of it in the context of that same T account, I put up the same one that I used earlier, just a hypothetical bank. What does it mean? Well, as I did earlier in a lot of questions, we use 10% as our kind of de facto reserve requirement. If there was a 10% reserve requirement, that means that 10% of demand deposits must be held on reserve. So 10% of $1 million is that 100,000. This current bank has $500,000 on reserve, meaning they have excess reserves of $400,000 with a 10% reserve requirement. That's $400,000 they can lend. They've got to keep the 100,000. That's required reserves, but they can lend an additional 400. Well, with the reserve requirement dropping to 0, now they can lend it all. They don't have to keep any of that. So it increases excess reserves. It increases how much money banks have available to lend. And that's the point. The Fed is trying to get banks to lend money, to keep money flowing, to keep things going, so that the economy keeps moving, even when economic conditions say otherwise. All right, now we need to make connections. We've got to make connections between what policy is intending to do and then what happens on ADAS and what happens in the real economy. So central banks are going to manipulate money supply and interest rates. And then there's a domino effect from there. On the expansionary side, and take note of this because you can notate through these kind of flow charts how these events occur. On the expansionary side, we already said this, central bank's going to increase money supply, which is going to lead to a decrease in interest rates. Now we have to make the connection, make the leap to aggregate demand. And that leap is made by identifying the interest-sensitive components of aggregate demand, which would be consumption, investment, and net exports. And when interest rates fall, all three of those are going to increase. Again, we're speaking from a ceteris paribus perspective. When only considering the effect of interest rates, consumption, investment, net exports, they all increase, which means aggregate demand increases. We shift AD to the right, and as AD shifts to the right, price level goes up, output goes up, employment goes up, so we can assume unemployment goes down. That's the effect of expansionary monetary policy, buying bonds, lowering the discount rate, lowering the reserve requirement. Going the other direction, tapping on the brakes, the Fed contracts money supply. If they're to sell securities to banks, they're taking money out of bank reserves, they're contracting money supply, interest rates go up. With interest rates going up, consumption goes down, investment goes down, net exports goes down. AD shifts left, and we see a decrease in price level, decrease output, decrease employment. Again, in reality, what they're really trying to do is slow things down, maybe come to a soft landing, maybe just bring down the inflation rate a little bit. They're not necessarily trying to cause deflation that we're showing here, but they are trying to slow things down, slow down aggregate demand so that inflation does not become an issue. In the context of AP Macro, this is the chain of events you would show as a result of a contractionary monetary policy. All right, finally, last thing for monetary policy. There are lags to monetary policy just as there are to fiscal policy. There's a time gap between when a problem has been recognized and a policy is actually put into place and has an effect. What I want to point out is that the lags are going to be opposite of what we see with fiscal policy. For monetary policy, there's a really short inside lag. They're able to respond relatively quickly as compared to fiscal policy, but the outside lag is a little bit longer because that money, that change in money supply, that change in it's got to work its way through the banking system. Now, that said, it's a relative term, and even in the time I've been teaching, it's probably gotten shorter as the public has become more informed and aware of what's happening. But I think it's worth asking, why is that? Consider the policy-making process for these two bodies, these two policy-making bodies. For fiscal policy to be enacted, there has to be action by both Congress and the president. I'm talking from an American perspective, but there's truth to this in whichever economy you look at. And that takes time. They've got to first recognize the problem based upon lagging indicators, such as unemployment, inflation, and output. Then they've got to come together and form a fiscal policy solution. All of that takes a lot of time. You think about how many people are involved in that, all of the House, all of the Senate, and the president, all their advisors, all the politics they're going to consider. It takes a long time. But once it's implemented, checks can be written, taxes can be cut, and the lag is very short as the impact can be felt relatively quickly. On the monetary policy side, however, you have the FOMC. There are 12 voting members of the FOMC when we have a fully staffed board of governors. Now, all the presidents of all the district banks are able to come and have their say, but even so, if there was an issue that occurred this morning, the FOMC could have a conference call in the afternoon and make a change to monetary policy. So they can have a very quick turnaround when it comes to monetary policy, but it takes a while for it to take hold. It takes a while for the economy to adjust because it has to work its way through banking and has to work its way through interest rates. All right, finally, loanable funds market, our third and final topic for the day. And let's start by, again, just looking at the graph. Now here we're looking at relationships between real interest rates and the quantity of loanable funds. Real interest rates, of course, are going to consider inflation over time. They're the real return that lenders and borrowers can expect. Consider the Fisher effect. Again, whenever you see nominal and real interest rates, think about the Fisher effect, the Fisher equation, and that relationship between the two and how inflation defines that relationship. Demand for loanable funds. Demand for loanable funds obviously illustrates an inverse relationship between real interest rates and the quantity of loanable funds demanded. But you've got to ask yourself, who's demanding loanable funds? What does that mean? And a way to simplify that, demand for loanable funds represents borrowers. I don't care where they're borrowing from. It could be private households, it could be businesses, it could be government. It just represents those that are borrowing. That's what it means to demand loanable funds. By the way, that term loanable funds, students get confused by that, I know. Stop and just think about what that is saying. It's funds which are available for lending. And what this market is trying to show is that relationship between borrowers and lenders. So the demand side, those are the borrowers. The supply side, those are your lenders, the supply of loanable funds. Now we're going to associate that savers, but what does it mean when you're savers? When you put your money into a savings account at a bank, what are you doing? You're lending your money to the bank. You're saying to the bank, hey, I've got this sum of money. I'm not going to use it today. I'd like to have it back in the future, but you can use it for now. That's essentially what you're saying. You are supplying loanable funds to a bank. So that's what the supply of loanable funds is. It represents savers. We want to understand the relationship then between savings that I just referenced and investment spending. And we've got to define what savings would be in both a closed and open economy. You know, at this point in the course, when you took this the first time, went through Unit 4 the first time, you were really probably dealing with a closed economy. Open economy didn't come until Unit 6. So we want to define national savings. So what is it? As simple as we can put it, it's the sum of private savings and public savings. Private savings are disposable income minus consumption. So the disposable income being your income minus taxes, disposable income minus consumption. Public savings simply being the budget balance, which could be positive or negative. We're used to it being a negative number because we typically have deficits, but it doesn't have to be. In the cases where there is a federal budget surplus, you would say there's been an increase in public savings. When we move to an open economy, it's the same thing, but we add capital inflow. So that financial capital that's coming in from abroad is part of national savings in an open economy. Why does any of this matter? Because there is an identity, there is a relationship between national savings and investment spending. And we need to be aware of that. And as changes in national savings occur, whether they be because of disposable income, consumption, budget balance at the federal level, any of those things, as national savings changes, investment spending changes, because savings are truly the source of investment spending. And as you know, because you've been through Unit 5, think down the road a little bit, those changes in investment spending can have an impact on capital formation. They can have an impact on economic growth. It's not just that short run change in aggregate demand we're concerned with. It's also that long run effect on economic growth that we want to be aware of. So be aware of that and be able to define what those national savings are because of the impact they can have on investment down the road. All right, so back to the graph. Like every graph we've dealt with, we've got to be able to identify equilibrium here. Again, it's that point where the two curves intersect. It's where quantity demanded equals quantity supplied. We want to be aware of the fact that surpluses and shortages can occur. Again, we're simply dealing with supply and demand here. The same rules apply. Just as I said when we talked about our money market, the same rules apply. If real interest rates are higher than the equilibrium interest rate are, then we're going to have a surplus indicated in green. If real interest rates are lower than equilibrium, then we're going to have that red line. We're going to have shortages. And again, self-correction will occur. Interest rates will go back to equilibrium. Quantity will go back to equilibrium as well. Let's talk about shifters a little bit. A shift in demand for loanable funds. Again, the question you have to ask yourself, why would people in this economy be more willing and more able to borrow for reasons other than interest rates? Obviously, a change in interest rates moves us along the demand curve. What other factors lead borrowers to want to borrow more money? Two that come to mind, and there are many more: perceived business opportunities in government borrowing. You also have mentioned here investment tax credits. Anything other than interest rates that would encourage investment spending would probably lead to, and in our context will lead to, an increase in demand for loanable funds. So on the case of perceived business opportunities, if businesses are more confident about expected returns in the near future, if they anticipate higher returns, they're going to want to borrow money and spend that money on investments to earn those returns. Borrowing is also going to be displayed on that demand curve because, again, that demand curve represents all borrowers, whether they're private households, private businesses, or if it's the public, if it's the federal, state, or local government. So we're going to go ahead and put deficits on that demand curve when they occur because you have essentially the government borrowing from that same pool of loanable funds that everyone else is. Supply is going to be influenced by savings behavior, private savings behavior, and capital flows. So again, if something other than interest rates leads households or businesses to want to save more money, we're going to see an increase in supply of loanable funds. When there's financial capital inflow, we see an increase in supply of loanable funds. And of course, the opposite of those two is going to lead to a decrease in the supply of loanable funds. All right, so that's I told you it was a lot of stuff, and that was a lot of stuff. Let's do a couple FRQs, short FRQs, just to make sure that this is making sense to us and that we're able to apply this in the context of AP Macro. Of course, real world application is different. There are more tools, there's more going on, there's more in motion, but let's look at it purely from the perspective of AP Macro for now. So first one, practice FRQ. Assume country X's economy is currently at full employment. Now, if I'm taking this test, if I'm answering this question, I'm going to have some scratch paper nearby. I'm going to go ahead and write that down somewhere. I'm going to draw a graph maybe, or I'm going to do something to notate that that's my starting point, because that's going to be important at some point. So country X is at full employment. This is not part of your answer. You should not include it in your answer, but I'm going to write this down somewhere just to remind myself of where we're starting. All right, with that in mind, move on to part A. If country X's net exports decrease, What will happen to price level in country X? Explain. All right, so again, go back here. In the context of ADAS, what do I do with this information? Net exports are decreasing. What does that happen? What does that do to price level? Price level is going to decrease. That's the assertion. I have to say that first. Explain what's the causal effect or relationship here. The decrease in net exports shifts aggregate demand to the left, decreases both real output and price level. So the question was, how do net exports affect price level? With the decrease in net exports, decrease aggregate demand, and we know that's going to bring price level down. For part B, draw a correctly labeled graph of the money market. Show the effect of the change in the price level identified in part A on the nominal interest rate. Okay, make a connection. Follow your prompt and make a connection. You have to show the effect of the change in price level. So what happened to price level? Price level went down. We said if price level goes down, demand for money is going to go down. So your correct answer has a correctly labeled graph, nominal interest rates on the y-axis, quantity of money on the x, money supply is vertical at M1. We have a downward sloping money demand, and then it shifts to the left, a decrease in money demand, and we have to show the decrease in real interest rates. We show with the little dotted lines taking us from equilibrium back to the axis. We show with the arrow indicating a decrease in real interest rates. All right. Based on your answer to part B, okay, I better back up. What happened in part B? Part B, interest rates went down because of a decrease in money demand. Based on your answer to part B, what will happen to the price of previously issued bonds? No explanation needed. I just have to know the relationship. The price of previously issued bonds will increase. I've got to know that there is an inverse relationship between interest rates and the price of previously issued bonds. Those previously issued bonds are now more attractive because interest rates are currently lower. So there's going to be an increase in demand for those bonds, which is going to cause an increase in the price of those bonds. You don't have to say any of that, but that's the underlying causes. And then finally, identify an open market operation that country X's central bank can use to offset the change in nominal interest rate for part B. So in part B, we showed a decrease in interest rates. To offset that, the central bank should sell bonds. I want to make a point here, though. Very common mistakes on the AP exam here. It said open market operation. A lot of people want to come back and say, oh, raise the discount rate, raise the reserve requirement. Can't do that. It specifically says open market operation. And when it specifically says that, you have to answer with either buy bonds or sell bonds. Purchase securities, sell securities. It means the same thing. In this case, because they're looking to raise interest rates, the answer is contractionary policy, sell bonds. You can't just say contractionary policy. That does not answer the question. You've got to say, what is the open market operation? It is to sell bonds. So that's the only correct answer to this question. Likewise, you can't put everything possible. You can't say sell bonds, raise the discount rate, raise the reserve requirement, contractionary policy. You can't do that. You have to answer the question that was asked. And in this case, the question that was asked was, what's the open market operation? Sell bonds. Done. Put your pen down, walk away. Or in this case, step away from the keyboard. All right. One more, pretty quick one. Loanable funds market in country Z is in equilibrium. Draw a correctly labeled graph of the loanable funds market showing the equilibrium real interest rate and the equilibrium quantity of loanable funds. That should be a gimme. We got to know our graphs. We have to know how to draw them correctly. So we have real interest rates on the y-axis, quantity of loanable funds on the x. We have upward sloping supply, downward sloping demand, and we identify equilibrium with R1Q1 with the dotted lines attaching back to the equilibrium on the curves to the axis. Part B, assume household savings in country Z increase. Okay, process that before you move on. Household savings are increasing. Will this cause a shortage or a surplus in a loanable funds market at the current equilibrium real interest rate? Okay, I need a graph if I'm going to do that. So I've got two options. I could go back and look at what I already did, and if I'm writing it down, obviously I'm going to do that. Or I could take a peek at question 2. I'm going to go ahead and move on to 2 and come back to 1 because I don't want to answer 1 without looking at a visual. So part 2 says, on your graph in part A, show the effect of the increase in household savings on the equilibrium real interest rate. That should be pretty simple. Increase in savings is going to shift supply to the right, resulting in a lower interest rate and a higher quantity of loanable funds at equilibrium. But now I've got to go back to B1 though. Don't forget that I skipped it. is this going to cause a shortage or a surplus at the original equilibrium real interest rate? So at R. If interest rate stays here at R, now there's your quantity demanded, but your quantity supplied is all the way out here. QS is greater than QD, which means we're going to have a surplus. There's where you could apply that understanding of markets not at equilibrium, because that is entirely possible, and that's possible to be a question. This is an actual AP exam question, so that's a possibility there. All right, finally, parts C and D. Interest rates just fell. Keep that in mind. Real interest rates just fell. Based on your answer to part B2, will lenders be better off or worse off? Well, if you're lending money and interest rates are going down, you're going to be worse off. Your return, the real interest rates, the real return, your return is going to be less than it used to be. Based on your answer to part B2, again, that was real interest rates falling. What will happen to investment spending in country Z? Explain. Well, if real interest rates go down, how does that affect investment? Investment spending will increase. Explain. A decrease in real interest rates reduces the cost of borrowing, which increases investment spending. Again, making connections. So much of economics and economic thinking is about making connections, understanding causal relationships. This leads to this, leads to this. You've got to be able to think that way. Okay, that's everything. And that was a lot. Like I said, 4.5, 4.6, 4.7. That was a lot of objectives, a lot of skills that we had to apply there. Thankfully, it was a review, so we did go a little bit quicker than maybe you'd like, and if it was the first time around, but hopefully it did make sense to you. Moving forward, we're almost done with all the content that we're going to do for review. We're going to move into some practice questions in the coming weeks, so keep an eye on that. In the meantime, if you're concerned about technology needs, if you're concerned about connectivity, please contact the College Board, cb.org/tech. And finally, thanks for watching. Appreciate you being here with us today, and hope you're doing well, and hope you'll come back for the next one. Have a great day.